All right, so it's the day after when the Fed met, and well, a lot of people since then just had to go back and sort of sharpen their pencils, including the Fed, even though they continue to stick with the game plan of 3 rate cuts this year, which of course they outlined months ago. They haven't changed on that. Powell and company, it seems maybe they've got the champagne chilling right now in anticipation of a soft landing being really right in reach. Wall Street wants to believe it, obviously, but Main Street cannot believe it, and a lot of other folks are just simply confused. In fact, The Economist magazine, not buying it at all. This week, they posted this piece, The Difficulty of the Last Mile of Inflation. And then there are actual economists that see the nation edging closer toward stagflation. Here now, TrendMacro Chief Investment Officer, Don Luskin. Don, I wanted to, this Economist article was intriguing to me. Because they talked about the differences on CPI and PCE. The Fed uses the latter, suggesting that the divergence is notable because the CPI is more rigid. If that's the case, is the Fed using the wrong metric to begin with?
No, I mean, the personal consumption expenditures inflation, the Fed's favorite, that's been around for about 60 years. And over 60 years, it has always been a little bit lower than CPI that the rest of us use. It's about 0.5% on average. Right now, it's about 1% lower. So if anything, it's giving a rosier picture. I understand why the Fed prefers it. It is a better constructed index. It changes its weightings of all the components that go into it every single month as buying patterns change. It doesn't wait a whole year to do that like CPI did. So that's why in January we got this seemingly shocking CPI number, but that's just because they waited a year to update the weights. PCE does that every month. So it's this nice, smooth, reliable series, and the Fed is right to favor it. And it's giving us a 1% better answer, too.
All right. Now, those who are in the rate cut camp say the Fed is waiting too long. And it should be noted that this right now is the second longest pause between the last rate hike and rate cut on record. Does that concern you?
Well, no, it doesn't. And the reason why is because most of this very rapid, very violent rate hiking regime actually took place 2 years ago, right? I mean, they literally lifted off exactly 2 years ago. Then they launched into that sequence of 4 75 basis point rate hikes. That got done in November of 2022. That's when most of the lifting got done. Then there were just some, there were pauses and there were hikes. But if higher interest rates, like we've had since the July FOMC at 5 3/8, if that was going to crash this economy, it would have. Lags don't take that long, especially considering that the worst part happened a year and a half ago. So the evidence of the real world all around us every day, 24/7, is that we have a booming economy, an unemployment rate with a 3 handle. Everything is beautiful. These interest rates that we have right now, and you're right, we've paused there for a very long time. The economy is behaving so well, that interest rate must be about right. Otherwise, we'd be having the hard landing or the soft landing. We're having what I predicted all along, no landing at all.
I got less than a minute to go. You wrote a lot of things this week, and we're not going to have time to go through all of them, but good stuff as usual. I implore everyone to read your work, where you said we think deflation would be good for growth, but that the markets fear it. Now, when I read that, I suspect that's because people read about 1929 to 1941. But what's everyone kind of missing then?
Well, we've got a decline in the money supply on a year-over-year basis for the first time in the history of the day that begins in 1959. And that probably means that we're going to have something that feels a little bit like deflation. But after the last 3 years, where we've had more inflation than we had over 40 years, the price level jumped 22% over 3 years. We need a little relief from that. Deflation will be a good thing, not a bad thing. Oh, yes, I know all about 1929 when we had deflation, but that didn't cause the Depression. The Depression caused the deflation. So if we get a little deflation now, welcome it. It'll be wonderful.
All right. And you know what? I'm going to sneak this in real quick. Quantitative tightening is as a myth. What do you mean by that?
All I mean is that when the Fed started doing QE all the way back in the worst of the pandemic, it really needed to do that because at that point, the bonds that it was buying were toxic assets.
Right.
A 10-year Treasury that's yielding only 31 basis points, which it was in the pandemic, you know that someday those yields are going to come back, and they have, and that's why Silicon Valley Bank failed. If the Fed hadn't done all that QE, all the banks would have failed. Well, everything's normal now. We have a booming economy. So, and we have a 4% 10-year yield. So we don't need the central bank taking toxic assets out of the system anymore. That's all that QT is. It's not tightening. It's normalizing. It's wonderful. Everybody finds something else to worry about. Not that.
All right. Well, this is America. We'll find something. Don, great stuff. Appreciate it, my man.
Thank you.